the markets, NASDAQ and S&P, you can see that that ride north out of that level this morning, well, was worth $2,400 per contract on the buy side swing at that stage. Kind of crazy, right? Kind of crazy, but beautiful at the same time. I mean, beautiful crazy. Fast money break off the bottom edge, slow grind back in, fast money break, slow grind back into this low volume node, fast money break, and so on and so on and so on. Crazy good, crazy easy. And obviously, if you just simply put your volatility narrative on top of that chart for yesterday, you would have had every single last inch of that move. Take a look at the two volatility lines. This is the volatility calendars in green, and this is the VVIX in purple. You can see that there's an incredible value for that bottom line to be bought into. No ifs, no buts. It's got to be a buy. And obviously the takeaway from that buy was simply sensational. Crazy, crazy good, right? Crazy good. Now that's what we call trades. I mean, that is what we call a level, right? That is what we call a brilliant level. Now, bearing in mind that's not including the overnight longs that we've also been able to add to this into the next phase of this swing higher, as we broke those key levels in terms of the NASDAQ and the S&P. And if you just paid attention to the levels, you have made your month's money today, guys. Simple as that. You've made your month's money if you just paid attention to the levels. Crazy, crazy good. Oil's been a little bit of a challenge for anybody. We've been chatting about oil. I've mentioned to the guys in the room this morning, I have no oil trades today. The dollar flying against the supply line. We said that last night, that there was no trades. And again, today, there's been no trades except to catch the small swings, the individual intraday swings. And obviously, if you caught those small swings, then, of course, you've managed to make some pretty good gains. We had a chat about crack spreads, about the possibility this afternoon that maybe some of you might even try the RBOB. Trade the RBOB. Try thinking about the possibility of a crack spread position. Think about how you would leg into it. Think about where the advantage is. Think about where the edge is. And you're going to start developing the mind of a trader, a proper trader, not a retail trader that pays lip service to this type of information, but a proper professional that looks for that edge, that real money edge. So have a little development of your oil ideas this afternoon. Start thinking about where you're positioned against the crack spread and against RBOB, and think about demo trading out some of your ideas on RBOB. See how you get on. See how it feels. Check out what kind of volatility you get. Check out the depth of market. Check out the types of deltas that we see appearing on the RBOB markets. Have a look at it. In that way, you start to learn more about RBOB. It's those little processes that some of you absolutely do, and the guys that do it become incredibly successful because they understand the market so much better. And for a lot of people who don't do it, they're always just trading it as a blue line or a black line. What's the black line? What's the blue line? It never becomes anything. It never becomes significant because it's always just a line at that stage. So we need to get beyond that line narrative. We need to understand the lines. And that's why we suggested that you go through that process. We also came back to a process on bonds. We introduced the BOB spread back into the room a few days ago. And we developed that idea out this morning in Classroom. We might get a chance to look at it again this afternoon. I don't know. We'll see what else comes up. But certainly, it's another piece of information regarding bond trades that a lot of people perhaps don't get a chance to look at, don't try and understand enough about. But obviously, when you understand it, life can get a little bit easier. And you can start to see some crazy good trades. In fact, so much so we marked off some brilliant trades this morning from the London session, and we went through the entire setup for these two trades, the buy trade off the bottom edge in here and the sell trade off the top edge in here. They were identical reversal trades, identical mirror image type trades. And they had exactly the components that we had touched on in Classroom regarding the front end of the curve, the inflation, the break-evens, and the deltas, all lining up for what we would call a perfect benchmark example morning. And whilst it's not the biggest top to bottom swings, it's not a bad take in terms of money. It's a $500 rally, and when I took the screenshot here, we were up a couple of $100, $700 in total per contract. You trade a 5 lot in bonds, guys, that's a $3.5 grand morning for you right there on a benchmark. Not a bad take for anybody in the market, is it? 3.5 grand. You'll take that any day of the week. And yet it was such a high quality benchmark that it was almost unbelievable just how good the benchmark process on this trade was. We can obviously, as I said, if there's an interest in it, we can touch on it again. It's about learning a lot about bonds themselves and drilling down into the individual pieces. And the takeaway from these two trades was absolutely spectacular. It's not about the outcome. It's about the input into the process. Whether this makes $100 or $5,000, it's still the same input into the process. And obviously, it's that input into the process that gives you the difference between you and any other retail trader on the planet, and it puts you into the same desk as the Goldman's traders, as the Deutsche Bank traders, as the Merrill traders. You're trading the same information points to try and find these outcomes. So crazy good trade on bonds, fantastic benchmark. And as I said, it was a benchmark almost entirely derived from delta and pricing, delta and curve pricing. And obviously that's where we've got that bit of business. Like today, at this present moment, the top edge bond looks like a reasonable opportunity to sell into, but it's nowhere near the same as a benchmark. Nowhere near the same as this top edge benchmarkable opportunity. And the reason for that is because of the oil. So when we look at this current bottom edge here, yes, this originally looks pretty good for this benchmark, but you can see that the black line, which is what we're trading, the short-term interest rates, is actually trading a little bit hot against this red line. And because the black line's trading hot against the red line, there's always a chance that that might not reverse out. So it's not a benchmark. It's good. Don't get me wrong, it's good. And I have been selling on this uptick phase here. But it's not a benchmark. It's not even close yet to being as good as any of the other trades. It's slightly in the wrong order. In terms of the market internals, it's a benchmark because the curve is absolutely setting up exactly as we claimed, exactly as we showed, exactly as we demonstrated this morning in terms of that little classroom. However, with the inflation in the wrong place, it means that you're obviously relating to the inflation line and adding a little bit of weight to it, saying just got to be careful here. This is not as good. It is not as good. And if we treat it the same, you're going to end up getting the wrong trade at the wrong price. So don't treat it the same. Treat it as slightly less impressive, but obviously also take an idea that perhaps oil prices are going to need to be purchased. If this is what the curve is suggesting, why are oil prices down here? So whilst it doesn't open up a possible bond trade, it certainly opens up a window of inquiry into why oil prices are trading so discounted. And therefore, you could start exploring that as a possible play. So it doesn't mean that you're left high and dry as a trade opportunity. It just means that trade opportunities in a different location from where you thought it was going to be the first time you take the bit of business. Okay, so you can obviously start, the idea is now there. You can start investigating that idea. This is why we don't trade lines, we trade markets. It's not a buy on a red line, it's a buy on oil. It could be a possible buy on a retest on oil into these low prices. So we start watching, we can see some absorption already visible on oil. We can see somebody's already at work on oil. We can recognize the possibility that it's there. We can switch into the oil market and we can look for that opportunity to try and get a bit of business done. It makes sense? Makes a lot of sense, doesn't it, when you think about it? So the sell on bonds is now turning along quite nicely. I hope you've been able to take a little piece of it. You had all the benchmarks bar oil for that sell. Did anybody go ahead and take the play? We did tweet it out. We were on offer watch. We did get a little bit of a book flip there into that 4, 5, 6 area. And you should have been able to get something done. But at 4 worst case, guys, 4 worst case, yeah? I hope nobody's paid 3 for it, but I hope you've managed to get 4 worst case on that bit of business. And you've managed to get an easy profit and a stop at break even at the moment, guys, yeah? Solid. Solid as a rock. So it was exhaustion, guys.